Ever wondered about the complexities of farm loans? Today, we're here to unravel these intricacies for you. Farm loans, as the name suggests, are financial tools designed specifically to support agricultural operations. They come in many shapes and sizes, each with their unique terms, eligibility criteria, and application processes. From operating loans to real estate loans, the variety can often seem overwhelming. But worry not, we're going to simplify these complexities, providing you with the essential information you need. We'll also delve into the world of interest rates, discussing what influences them and how they impact your loan. Moreover, we'll explore various repayment options and strategies that can assist you in managing your loan effectively. And finally, we'll touch on risk mitigation and financial management to ensure you're prepared for any unforeseen circumstances. With this knowledge, you'll be better equipped to navigate the world of farm financing. Let's start by looking at the various types of farm loans available to agricultural producers. First up, we have operating loans. These are short-term loans designed to help farmers cover the costs of day-to-day farming operations, from purchasing seeds and fertilizers to paying for labor and equipment repair. The eligibility criteria for these loans include a good credit score, a solid business plan, and proof of ability to repay the loan. Next, we have equipment loans. As the name suggests, these loans are used to purchase or lease farming equipment. They can be a real lifesaver when that old tractor finally gives up the ghost, or when you need to upgrade your machinery to stay competitive. Then we have real estate loans. These are long-term loans used for purchasing land or making significant improvements to existing farm property. They require a thorough appraisal of the property in question and, like other types of loans, a good credit score and proof of income. Lastly, we have farm ownership loans, designed to help farmers purchase, expand, or build upon their existing farm properties. They're a great option for those looking to take their farming business to the next level. Now let's talk about government-sponsored loan programs. The United States Department of Agriculture's Farm Service Agency, or FSA, offers a range of loan programs designed to support farmers. These include loans for beginning farmers, socially disadvantaged farmers, and emergency loans for farmers hit by natural disasters. Similarly, the Small Business Administration, or SBA, provides loans to small businesses, including farms. These can be particularly helpful for farmers who might struggle to secure traditional financing. Getting a farm loan can seem daunting, but understanding these different types of loans and the support available can make the process a lot smoother. Understanding these different types of loans will help you determine which one best suits your farming needs. Now that you are familiar with the types of farm loans, let's delve into understanding interest rates. Interest rates. Those two words can either bring a sense of relief or a wave of anxiety, but knowing how they work is key to making smart financial decisions. So, what factors influence farm loan interest rates? Well, it's a mix of market conditions, your creditworthiness as a borrower, the term of the loan, and the collateral you're providing. Market conditions fluctuate, and they are influenced by a myriad of factors from inflation to economic growth. Your creditworthiness, on the other hand, is basically a measure of how reliable you are in the eyes of lenders. A higher credit score can lead to lower interest rates, so it's worth investing time in improving your score. The term of the loan and the collateral are also significant. Generally, the longer the loan term, the higher the interest rate, as the lender is taking on more risk. As for collateral, if you're able to provide more, lenders may offer you a lower interest rate. Now let's chat about fixed rate versus variable rate loans. A fixed rate loan means your interest rate stays the same for the entire term of the loan. This can be great for budgeting, as your repayments won't change. A variable rate loan, however, means that your interest rate can change over time, usually in line with market fluctuations. This could either work in your favor or against you, depending on the situation. To secure a competitive interest rate, there are several strategies you can employ. As mentioned earlier, improving your credit score is one. Shopping around for different lenders can also be beneficial. Don't just go with the first offer you receive. Lastly, consider leveraging government loan programs. These often offer more favorable terms and can be a good option, especially for new or small-scale farmers. Grasping how interest rates work can help you make savvy financial decisions. And remember, the goal is to secure a loan that supports your agricultural endeavors without causing financial strain. Understanding interest rates is a crucial part of that puzzle. Having chosen the right loan and understood the interest rates, you now need to consider your repayment options. The way you repay your loan can significantly impact your farm's cash flow and overall financial health. So, let's explore the different options available to you. Traditional amortizing loans are quite common. Here, you make regular payments of both principal and interest, gradually reducing your loan balance over time. This option provides a predictable repayment schedule, which can be easier to manage. Next, we have balloon payment loans. In this case, you make smaller payments throughout the loan term, and then a large balloon payment at the end to cover the remaining balance. This option might work well if you expect to have more funds available in the future, but it does come with a risk if that anticipated income doesn't materialize. There are also flexible repayment schedules designed to match the cyclical nature of farming. Payments may be scheduled around your harvest seasons when you're likely to have more cash on hand. This can be a great option to preserve cash flow during lean periods. No matter which option you choose, cash flow management is crucial. Understanding your farm's income and expenditure cycles will help you select a repayment option that aligns with your cash flow. Maintaining a budget and regularly reviewing your financial projections can be invaluable here. Now let's talk about strategies for loan repayment. Refinancing, for instance, can be a good option if interest rates have dropped or if your financial situation has improved. You could also consider loan consolidation, combining multiple loans into one, potentially simplifying management and reducing monthly payments. Early loan payoffs are another strategy. If you find yourself with excess cash, paying off your loan early can save you money in interest over the long run. But be sure to check your loan terms first, as some loans may have prepayment penalties. Choosing the right repayment strategy is crucial in managing your farm finances effectively. Remember, every farm operation is unique, so what works for one might not work for another. Stay informed, stay flexible, and you'll find the best path for your farm's financial success. Now, let's talk about financial management and risk mitigation. As a farmer, you're not just growing crops or raising livestock, you're running a business, and that requires a keen understanding of financial management practices. Start by establishing a budget that outlines your expected income and expenses. This will give you a clear picture of your financial situation and help you make informed decisions about your operations. But don't stop at creating a budget. Regularly review and update it to reflect changes in your business and the market. Next, consider cash flow forecasting. This process allows you to anticipate the inflow and outflow of cash in your business, helping you plan for the future and avoid potential cash shortages. It's essential to be realistic and consider factors like seasonal fluctuations in income and unexpected expenses. Risk assessment is another critical component of financial management. You need to identify potential risks that could affect your business, such as weather events, disease outbreaks, or market changes, and develop strategies to manage those risks. Speaking of managing risks, let's delve into risk mitigation strategies. One such strategy is crop insurance, which can protect you against losses due to adverse weather conditions or price declines. Diversifying your farm operations can also help spread risk. For instance, if you only grow one type of crop and it fails, you could face significant financial losses. But if you grow multiple types of crops or also raise livestock, you have other sources of income to fall back on. Building an emergency savings fund is another way to cushion your business against unforeseen events. This fund can help you cover unexpected expenses without having to borrow money or sell assets. Lastly, maintaining open communication with your lenders is vital. If you're facing financial difficulties, don't hide it. Speak to your lender as soon as possible. They may be able to provide options such as loan restructuring or temporary payment relief. Professional financial advice can also be invaluable, helping you understand complex financial concepts and make sound decisions. Stay informed about changes in loan terms and conditions too, as these can significantly impact your finances. Implementing these strategies can help safeguard your farm business from financial uncertainties. We've covered a lot of ground today, from understanding the types of farm loans to managing financial risks. We've explored the myriad options available to agricultural producers, detailing operating loans, equipment loans, real estate loans, and farm ownership loans, and we've highlighted the crucial role of government-sponsored loan programs. We've dissected the factors influencing farm loan interest rates like market conditions, borrower creditworthiness, loan term, and collateral. And we've outlined strategies for securing competitive rates. We've navigated through various loan repayment options and discussed the significance of cash flow management and budgeting. We also highlighted strategies like refinancing, loan consolidation, and early loan payoffs to optimize financial flexibility and minimize interest costs. Finally, we've given you guidance on financial management practices and risk mitigation strategies to protect against unforeseen events and ensure loan repayment capacity. Remember, understanding your farm finances is key to your agricultural success. Don't hesitate to seek professional advice when needed. Thank you for joining us today.